Hello, everyone. My name is Todd Rosenbluth. I'm Senior Director of ETF and Mutual Fund Research with CFRA, and I'd like to welcome you to today's webinar, How and Why to Consider Smart Beta ETFs. As you'll see here on this upcoming slide, we're going to have a pretty healthy agenda. We'll talk to you about the state of the ETF market. We'll have a discussion with my fellow panelists I'll introduce in a moment. CFRA will come back on to talk about the specific Smart Beta ETFs that were highlighted, and then we'll take your questions. So during today's session, we'll hear from a panel of experts from BlackRock, JP Morgan, and Oppenheimer funds as we review the growing usage of Smart Beta equity and fixed income ETFs and the appeal of these strategies for investors and their advisors. Before we get started, I want to remind you that today's session is being recorded, and a link to the recording will be made available within the next few business days. During today's session, you may submit questions using the GoToWebinar questions panel, and we'll do our very best to answer as many as we can. Before we go further into it, let me introduce our speakers on the slide that has pictures of our speakers here. So Holly Framstead, U.S. Head of iShares Factor ETFs, Yasmin Daya, Executive Director, Head of America's Beta Specialist Team at JP Morgan Asset Management, and Dave Mazza, who's Senior Vice President and Head of ETF Strategy at Oppenheimer Funds. With that, let's move further into the presentation, and let's talk to you about CFRA Research now that you're part of our webinar here. So on the next slide here, we're just going to remind you about our overall approach and what we offer to our clients and their end clients. So we're providing weekly market commentary, sector insights, and portfolio guidance, specifically looking at sectors and industries. Earlier today, we made a couple of sector recommendation changes. Those of you that have access to the MarketScope Advisor will note the changes in materials and in real estate. We're using that sector as well as our company-specific research, qualitative and quantitative research, to drive what we're going to be talking about here, which is ETFs, as well as our mutual fund research. And we're constantly putting out differentiated idea generation, focusing on forensic accounting, legal, and exception-based insights. On the next slide here, just let's go a little bit deeper into why CFRA and our expansive coverage. So you'll see the listing, a breakdown of qualitative and quantitative companies, specifically as we look at individual indices, both large cap, the S&P 500, to the multi-cap, Russell 3000 and S&P 1500, and our coverage is global. We've got broad coverage in Europe and in Asia as well. And this, on the next slide here, helps to support our overall coverage universe, as well as that we're good at covering stocks and individual funds. So on the left-hand side of the screen, you'll see our 5 stars. That's our stocks. The strong by recommended stocks have done a very good job of outperforming. Our analysts are making great calls, outperforming the broader market, and you can see an acceleration in recent years, specifically with our strong by recommended stocks. On the bottom is what's called our biggest concerns portfolio. That's coming from the forensic accounting side, and the negative numbers are real. You'd want to see that for stocks you're recommending people either avoid or from a shorting perspective, and our forensic accounting research has done a great job, both not only in North America, but outside of the United States. And recently, since CFRA bought the S&P research business, we've seen the benefits of both those attributes for our ETF research. The ETFs we like have outperformed the broader market. Equally as important, the ETFs we like the least, or the underweight rated ETFs, have underperformed, and that's been consistent. And you can see very nice charts for our equity ETFs, and we separately have research for fixed income ETFs. And lastly, on this next slide here, our independence is important to our clients and hopefully to their end clients. We don't manage money. We don't make trades. Our independent investment research is conflict-free. When we say we like something, it's for the fact that we think it's going to go up. If we don't like it, it's because we think it's going to underperform, and you can have confidence in the research from that perspective. Now let's dive into the ETF market here. On the next slide, what you'll see is just a state of the overall market. So on the right-hand side, we're approaching $4 trillion in assets. We'll see if we get there in the fourth quarter, or certainly we think in 2019. The majority of that pie is U.S. equity, with a nice chunk as well for international equity, and roughly under 20% that's in fixed income assets, and a very small chunk that's in commodities and other related products. What we've seen in 2018 is the pie continues to expand, over $180 billion as of when we put this chart together and counting, of new money flowing into ETFs. Obviously, the growth in the U.S. stock market is helping that as well. But what we've seen is fixed income assets we've really seen a growth in that as investors have been gravitating towards those products. And I think we'll touch on some of that as part of the Q&A session. But we've really seen continued demand across a variety of products. On the next slide here, let's just talk about where specifically the money has been flowing. And while I won't get into the depth of individual products or the asset managers here, the ETFs that are on this list are market cap weighted. They were the earliest products for the most part. They are well diversified from a sector, from a style, from a regional perspective when we're talking about outside the United States, either in emerging markets or developed. And there certainly has been a shift towards products that are lower cost in nature. There's been demand for some of the lower cost products, in particular, share gains that are taking place in that regard. That said, even though there's no smart beta ETFs on this biggest inflows or outflows, on the next slide here, you'll see that we've really seen a pickup in demand for smart beta strategies. Now, the term is loved by, I think, nobody that's out there, but yet the money continues to move into these products and with unique characteristics. So over $35 billion have flown into smart beta strategies overall. And what we've seen is this has really been a year for both momentum and multi-factor ETFs. In the first half of the year, we've started to see value pick back up in the third quarter, demand for value-oriented ETFs, and dividend strategies that were out of favor in the first half. As you can see here, negative flows or outflows during the period of time. We've seen them pick back up. We've seen inflows in the third quarter, and I think that's interesting, as well as the Fed is likely to be raising interest rates later today. On this next slide here, before I get to my panelists, just to highlight to you, we talked about multi-factor ETFs. They come in many different flavors, and it's something that we wrote about as commentary. You'll find as part of the resource, as part of the registration center, the demand for individual products, and specifically multi-factor products that combine not only low volatility or momentum or quality or size or value, but in different flavors of that. Some have a little bit more, some have a little bit less. And there's a handful of products that are out there that include dividends and other factors as well in the multi-factor side of things. So I'm going to pause here. We'll move to the next slide, and I'm going to bring back in my colleagues from iShares, from JP Morgan, and from Oppenheimer. We're going to cover a couple of questions. You'll see the questions here on the screen, and we're going to rotate through the speakers. So Holly, let's bring you back in. Holly Framstead, U.S. head of iShares Factor ETFs. Let's start this first one with you about the benefits of smart beta strategies when building. I apologize. I was on the wrong slide. What's driving the growing use of smart beta ETFs by advisors this year? Holly?
Thanks so much, Todd. We're seeing advisors increasingly turn to factor ETFs as a result of, I think, three main things: time, tools, and trust. So first, time has allowed factor ETFs to prove their power in offering diversification from the market. Tools like the Factor Box, which we launched earlier this year and you can find on factorbox.com, are helping to transform our understanding of factors in ETFs as a true driver of returns in active and passive funds. And last but not least, trust. Factor ETFs have been in the market now for quite some time, and by delivering on what they say they will, it's helped build trust with advisors and their end clients who are really looking for something more than average. As the strategies have had an opportunity to be in the market and prove their worth, and what I mean by that is delivering on superior returns or reduced risk, as that tends to be the main investment objectives that one seeks when looking at factor investing ETFs. They're delivering on these outcomes at a lower cost and in a more tax-efficient way. And as a result, what we're finding is that investors are beginning to take notice and increasingly think about swapping out of their higher cost, potentially less tax-efficient active mutual funds for an ETF. For example, increasingly we're talking with advisors about swapping into single factor products like our iShares Value Factor ETF, ticker VLUE, when thinking about replacing an active value mutual fund, or swapping into our iShares Momentum Factor ETF, ticker MTUM, when thinking about replacing a growth active manager. These simple and intuitive swaps in the portfolio can have a really meaningful impact on the client's bottom line, which is why I think we're starting to see that shift. What this means, I think, is for the first time there are intuitively designed products that in many ways mirror the fundamental investment tenets that advisors have long turned to active management for, which means that without changing their investment philosophy, advisors now have the tools to potentially reduce costs and improve tax efficiency by swapping vehicles. The ideas themselves aren't new, but the ETF vehicle is really the game changer here. And there's a brochure on the registration page that's called iShares The New Style Box, which really talks about this concept a bit further.
Thanks, Holly. Yasmin, I guess same question to you about the growing use of smart beta ETFs by advisors.
Yeah, I would echo a couple of Holly's comments there. I think in particular, the point around track record is really important because I think one of the significant hurdles that existed for advisors was really the worry around performance expectations. Or really, how do I know what these products are going to do in my portfolio and how can I understand when they're going to work and when they're not going to work? And so as these products are building track record and experiencing performance in different market environments, I think that's helping advisors to get more comfortable about what they can expect. The other really critical point, I think, is around the measurement tools. I do think another hurdle that existed that I think we're making a lot of progress on is the very fact that for many advisors, they didn't really know what their factor footprint was today, which makes it very difficult to then think about what you would want to add to your portfolio. So for example, at JP Morgan, we have a portfolio insights program. It's one of the services we offer advisors. Essentially, it's like going to the doctor and getting a diagnostic on yourself. It's really getting a diagnostic on your portfolio. And we added to that recently factors as another lens to understand what your portfolio looks like. And I think as you're seeing more and more of these tools come to market, people are beginning to understand what opportunities may exist in their portfolios for a factor-based product. So for example, if you did go through that analysis and realize you were underweight a factor, it may make sense to use a single factor to even out that portfolio. So I do believe as more tools become available to advisors and more information around their factor footprint is clear to them, you're going to continue to see a growing adoption of factor-based products.
Thanks, Yasmin. So let me bring Dave Mazza of Oppenheimer Funds into this part of the conversation. Dave, your take on growing use of smart beta ETFs.
Yeah, I think to emphasize one of the points that my fellow panelists alluded to is the idea of access. Historically, strategies in the factor world were really only able to be accessed by institutional investors. And really what to Yasmin's points, what they had really focused on was looking at really the true drivers of risk and return in their portfolio and trying to decompose it. Maybe it's something more than just a particular sector over or underweight or a country over or underweight. Really, is there something fundamental that they were looking to drive returns? And historically, we've focused in on the size spectrum, meaning large, mid, and small, and then the value spectrum, meaning is a stock of or a portfolio, a value portfolio, a blend portfolio, or a growth portfolio. But with the introduction of greater technology, really in the form of factor ETFs, the precision that investors can have to access different parts of the market and build more prescriptive portfolios has finally emerged. So now an investor doesn't necessarily have to rely on, well, this stock is only a value stock. Well, in fact, it might be a value stock, meaning it's attractively priced, but it could actually have high quality of earnings, and maybe it's beginning to exhibit some momentum. So the lens, the prescriptiveness that factors can bring is quite robust. And now that there are additional tools, whether it's single factor portfolios that investors can maybe use in a rotational manner or to take discrete long-term overweights in a portfolio, such as low volatility persistently, that's really beneficial alongside with the growth of products that combine factors together that really gonna, again, give different prescriptive outcomes that, again, that advisors maybe had to rely on active managers to do so potentially in a more expensive, less tax efficient manner.
So thanks everyone. Thanks Dave for that last comment there. So on the next slide here, we'll show the audience the question I'm going to be asking, and I'll start off with you, Yasmin. The benefit of smart beta strategies when building a portfolio rather than using a more traditional market cap weighted approach tied to the S&P 500 or the Russell 1000, for example?
Yep, it may make sense to take a step back, in fact, and you sort of mentioned this in your comments earlier, which is the challenge with that name altogether, smart beta. And the reality is that depending on how you define it, it actually changes quite significantly what you actually categorize within that term. Maybe one definition to throw out there is to refer to smart beta as a rules-based product that does something different in its process than market cap weighting. And so, said differently, what that really means is it's bringing the benefits of efficiency and transparency that are often associated with indexes, but the actual rule behind the indexes do something different. And that something different is what Holly really mentioned, which is dialing up or down the risk and return dimensions and delivering upon outcome versus exposure. What's true about that definition is that there's a whole range of products that fit within that category. So maybe focusing on two when we think about the benefit or why somebody would consider it. The first is single factor strategies. And as we've talked about, those provide you exposure to just one characteristic, let's say value alone or quality alone or momentum alone. And the benefit of these products relative to a broad market cap index is they allow you to get a targeted exposure and or express a view. So for example, as we've been talking about, you may think value is attractive right now. We think there's some reasons to have that same opinion. And now you have the ability to actually express that in your portfolio. So more prescriptive exposure. Or as I mentioned earlier, you can just be balancing out exposures in your portfolio. So really for single factor, it's about that targeted prescriptive exposure. Multi-factor strategies, on the other hand, those combine multiple characteristics as well. So we're combining things like value, quality, and momentum together in a packaged product. And from my perspective, the benefit of these strategies is that they can make for a superior core equity allocation relative to a traditional market cap weighted product. We think there's maybe two main benefits to really focus in on as it relates to multi-factor. The first is that market cap can be extremely concentrated by nature of the way it actually works. We're weighting by price. And if you think about the tech crisis and the amount of exposure you had to the tech sector alone, and that's true for the financial crisis and financial services, there's an opportunity, I think, through a non-market cap weighted mechanism to be more diversified. The second is, of course, what we've been talking about, which is adding factors like value, quality, momentum to identify more attractive stocks and enhance return relative to the broad universe. So when you put these two things together, I think the real benefit of a multi-factor strategy versus a traditional index is better risk-adjusted returns over a full market cycle. Now, with all that said, I think we're seeing advisors use multi-factor strategies in a variety of ways. One is as a replacement, given some of those benefits we've talked about, but equally, we are seeing them use it as a complement to their market cap allocation. And really, those advisors are thinking about how they can incorporate some of these different risk and return profiles, but also keeping in mind an eye towards tracking error, which we know is important for many advisors as they build portfolios. So despite the fact that we see this as sort of a superior core, I think it actually has implementation options both as a replacement but also as a complement to market cap.
So thanks for that, Yasmin. Dave, anything you want to add to that about the differences and benefits of going against the market cap weighted approach?
Yeah, I think what's great about the emergence of smart beta or factor-based ETFs is now advisors have additional tools at their disposal to construct the most robust portfolios possible for really the evolving market environment that we see today. And what's interesting about the evolution of indexing is really if we take a big step back, we can think about the fact that the Standard & Poor's index was potentially an improvement upon what Charles Dow had done with the Dow Jones Industrial Average, because that actually is a price-weighted index. And what's interesting is, as we know, it continues to get quoted in financial media today and remains some relevance, even though maybe the underpinnings of there, some could say, were pretty simple, because it's just looking at the price that a company trades at. When Standard & Poor's came along, they had additional data at their disposal. They could use the shares outstanding of a company. You could look at not just price, but actually, the market cap. And now more recently, because of additional technological advantages, both at the ability to trade stocks, construct indices in a robust way, now investors have these factor-based products at their disposal. And so what we can do is really use them to be able to not just necessarily rely on the largest companies based off of market cap to drive potential returns in a portfolio. Again, not that there's anything wrong with a market cap weighted approach. In fact, over the long run, maybe it can be quite robust. But let's say I persistently want to be able to either have the potential to remove volatility from my portfolio or increase returns. I can actually do so with relative, we can't predict the future, but using historical information, using expectations of what the future may look like with relative certainty of, again, what that outcome could look like based off of how a particular portfolio is constructed. For example, I may believe that in today's market, if I have an opinion that maybe we're getting long in the tooth from a cycle perspective, and I see valuations becoming richer, certainly they could continue to go up. Maybe I persistently still want to maintain exposure to the market, but I want to do so with more attractive valuations. I could leverage a fundamental indexing approach where I still have access to the entirety of all the securities in a particular index, but I'm weighting them very differently. So a fund in our lineup that takes advantage of that is ticker RWL, where actually it owns all the same stocks in the S&P 500, but does so based off of their revenues, not their market cap. And so this is just one particular example where an investor can gain greater control with these types of approaches, whether or not it's a fundamental indexing based approach, a very prescriptive single factor type access to the well-known proven single factors that exist out there, or a strategy that may be more prescriptive in the aggregate exposure it can provide in the multi-factor setting.
Thanks, Dave. So, Holly, let me get your take on this. iShares offers both market cap weighted strategies as well as smart beta ones. What's the benefit of using a smart beta approach?
Yeah, so I think a lot of the kind of benefits of one product versus another have been covered by both Yasmin and David, but I think, increasingly it's not a conversation about either or that we're having with clients. It's really a conversation about both, or I would actually extend it to all and talk about the inclusion of beta, traditional market cap weighted beta in a portfolio, factor exposures, and active management. Increasingly, as we talk with advisors, we're having the conversation around the fact that when building portfolios, it's really important to understand that factor returns can be complementary to sources of alpha and beta in portfolio construction. Increasingly, we see a number of advisors use all three of these drivers of return together in a portfolio because of this complementary source of returns. So what that means is you get greater diversification when you include all three. Many clients are looking at the market cap weighted beta as the core of their portfolio. So they're anchoring their core in these lowest cost market cap weighted products. And we think there's absolutely a ton of value to be had in doing so. Some of the benefits that comes with are it reduces overall costs, certainly, but it also ties performance of the portfolio or the model to an appropriate benchmark, which often is, as Yasmin talked about with tracking error, and clients are concerned about that, this is really what's going to help them reduce tracking error. Around that index exposure, though, many are turning to factor products, such as multi-factor funds like iShares ticker LRGF, to provide inexpensive access to fundamental, persistent, and well-understood drivers of return. Things like buying underpriced, high-quality trending companies, as an example. So think of these as characteristics you've always purchased that have always been complementing market cap weighted beta in a portfolio, but now they're available at that lower cost. And then around that, the third pillar, we see clients adding higher conviction sources of alpha to drive returns. Typically, these are based on things other than core factor-driven fundamentals. And so by combining all three of these drivers of return, advisors are able to more efficiently allocate to a variety of really lowly correlated sources of return in a portfolio, which can potentially improve outcomes for their clients. An example of this in action, because we talk to certainly a lot of clients, everybody's doing it differently, but BlackRock really eats our own cooking here. Our target allocation series of models are where our models-based strategy team, so it's not a set of portfolios that are constructed by certainly myself or anyone that's responsible for our market cap weighted beta products. They're blending active, index, and factor products together to drive returns for their clients. Not everyone is using all three of these. Certainly some are combining, as Yasmin suggested, factor products with market cap weighted beta. In other cases, you're seeing active products be combined with factors. But what we are seeing is that in practice, the evolution of blending that's available by bringing all of these products together is leading to better outcomes, and it's becoming increasingly more popular with the advisors that I've been working with.
So thanks, everyone. We'll move to the third question that's on the screen here. Dave, I'll start with you in particular because Oppenheimer has dynamic multi-factor ETFs. So the question as to what investment styles are worthy of increased exposure, this is a strategy or a set of strategies that actually tilts and rotates on a refresh on a monthly basis, correct?
Yeah, that's correct. So we actually launched 2 ETFs, OMFL and OMFS, that does take advantage of what you just said, Todd. And so the reason why we did so is because of the fact that factor performance tends to be cyclical by its very nature. And so what do we mean by that, the cyclicality of a particular factor? Really what I'm getting at is that when we talk about the discreteness and prescriptiveness of a particular exposure that you can gain access to with products of this nature, they're very distinct. And maybe, in fact, more distinct than, again, the historical just value versus growth or large versus small than what you would find historically. So, for example, there are factors because of the exposure that they're giving to individual companies that perform well during times of economic recovery or expansion. So for the most part, that would be emphasized by small companies through the size factor and inexpensive companies through the value factor. So these are what are called pro-cyclical factors. On the other hand, there are factors that actually do best during tougher times in a regime perspective. So these are things like the low volatility factor or quality factor. And really what that does is, of course, tilts toward companies that behave with less standard deviation than others in the low volatility setting, or in the quality setting, really seek out companies that have clean balance sheets and robust quality of earnings. And what we can do, in fact, with the approach that we've developed is actually leverage insights that we've historically used in active management settings to identify the particular regime we're in, which really spans from recovery to expansion to slowdown and contraction, identify that regime, and then tilt the ETF accordingly. For example, the signals today are telling us that U.S. leading economic indicators still remain robust on a trend perspective, but market sentiment has begun to wane. And what that does in the portfolio, it's still fully invested. It's a 100% long-only process, but actually we're now overweight the intersection of companies that both have the lowest volatility and the highest quality balance sheets and earnings. So what you tend to see is that boosts you up in large cap a bit and really gives you exposure to, again, companies with clean balance sheets and companies that are growing their earnings well. Now, of course, if that picture changes, we may get more defensive or may get more aggressive in the portfolio, really taking advantage of the fact that single factors and the combined factors together can tell you something discrete about what investors are thinking about from an economic perspective, a market perspective, and allow you to build portfolios accordingly.
Thanks, Dave. So Holly, I'll turn to you for that. I think you have a slightly different take. I think momentum, at the risk of getting in front of where you're going, I think momentum is in favor to iShares.
You're right. Thanks for stealing my thunder there. First, I'll say that our multi-factor, so we have multi-factor exposures as well, and ours don't take tactical tilts. So in our multi-factor ETF product, we really aim to provide strategic, steady exposure to all of the rewarded factors. The goal there is to achieve maximum diversification benefits, and it's intended as kind of a long-term holding at the core of a client's portfolio. However, with that aside, we do have plenty of implementation mechanisms that are more tactical in nature. Our single factor suite of products that I mentioned earlier really was designed to fit modularly into a model structure, which provides the tools necessary to express more tactical views for those who want to. And in order to facilitate that, we have a factor tilting model, which employs these single factor ETFs like MTUM, ZLUE, USMV, and it takes overweight and underweight positions in single factor funds based on our market views. In addition to that, our target allocation series of models, which I alluded to earlier, also implement tactical factor tilts as alpha generating overlay in our all smart beta model. So our current positioning, as Todd just alluded to, does remain bullish on momentum, MTUM, given its robust relative strength in the market and given strong dispersion within the factor. However, we also recognize that the slowing economic regime is beginning to favor more defensive factors, and we've increased our positioning to quality from slightly underweight to neutral in our factor rotation model accordingly. I think what this really speaks to is when thinking about taking tactical tilts toward factors in any portfolio or any investment, there are really multiple tenets that you should consider. We think it's not simply about where we're at in the economic cycle or relative valuations. Both of those are critically important inputs into the process. But we think that you should also consider the relative strength of a factor. So we believe there can be momentum on momentum as an example, and the dispersion within the factor. So if there's not a very big difference between the cheapest stock and the most expensive stock from a PE standpoint, as an example, how confident are you that buying the cheapest stocks is really going to result in a differentiated performance? I think the answer is you aren't, and as a result, you want to find and invest in factors when there is greater dispersion rather than less dispersion. So we think it's complex to do, but we have tools in the toolkit that allow our clients to make those tilts, and we provide guidance to do so to the extent that they choose to do that. But our core multi-factor funds don't have the tactical overlay.
So thanks for that, Holly. We'll touch on an example of that Dave offered in a moment, as well as that Holly offered, but I want to bring Yasmin into this part of the conversation. Yasmin, what are some of the styles that JP Morgan thinks are worthy of attention?
Yeah, sure. We may take a slightly different view here, and I'll segment out the discussion into two different categories. The first is factor timing and creating systematic models to take advantage of that. And the second is monitoring factor attractiveness to make a determination whether the opportunity set on a given factor is high or low. So thinking about the factor timing piece first, and what I mean specifically about that is systematically implementing a factor timing model. We do think there is information to glean, but one of the things I think is important to layer into this discussion is the idea of net of transaction costs and net of turnover, being able to actually take advantage of a fully systematic factor timing model. Breaking down into sort of the two components, because we do see them somewhat differently. As it relates to something like factor valuation, we do think there's a relationship between the current valuation of a factor and its future performance. Again, though, with the idea of only systematically taking advantage of it when you incorporate transaction costs and turnover, it can be difficult to actually, on a systematic basis, fully take advantage of those signals. The economic cycle one, which we've talked about, I think is a little more challenging for us, which is to say that there really are only a limited number of full market cycles in your sample set. So to determine your statistical significance, you don't have a lot to really look at. So what we tend to see is that while on average factors can map to certain parts of the economic cycle, the dispersion around those factors in those market cycles can be quite high. What that means to me is that it's already difficult enough to know where you are in a market cycle. I mean, it sort of feels a bit like a crystal ball. But then to layer on it that even if you did know the outcomes has a high dispersion around it, I think we see it as a very challenging model to implement. With all of that said, I do fully agree with Holly when we think about the toolkit. And so I think that you can absolutely monitor a number of different metrics to see if a factor is attractive or not right now. And that's the very reason we also launched a set of single factor ETFs to be able to take advantage of that through both a qualitative and quantitative process. When we look at the factor market right now, and we actually publish a quarterly factor views piece that shows our views across the full set of factors that we implement in, one of the areas we think looks pretty interesting right now is value. Our ETF is JVAL. And when we look at value, what we see is it's cheap relative to historical valuations. And this level of cheapness has historically been associated with attractive return on a forward-looking basis. I think what's also important to layer in on the value factor is that historically it's been very lumpy in the way it operates, which is to say that the outperformance we've seen from value comes in very short periods of time. And so it's really a factor that you want to be in when it turns around. It's kind of like a coiled spring. It springs back very quickly. So potential catalysts that we can see for a turnaround, since we all know how difficult value has been as a factor, could be something like earnings disappointments or an increase in interest rates. And so that is an area where we do see advisors beginning to move into, both layering upon the quantitative metrics that we do there, but also the qualitative assessment.
So thanks for that. Thanks to everybody for it, for that discussion. On that registration page, as well as in a follow-up, you're going to find supporting material about this. So if you didn't catch all of the great commentary that's there, iShares and JP Morgan and Oppenheimer have made available to us and thus to you collateral to support where they're positioned and why. For that, we at CFRA also published comments tied to some of the ETFs that we're going to touch on this upcoming slide, starting here, or I guess starting on the next slide. Sorry about that. No, let's go back to where we are here. But we want to just make sure that you can be able to keep up with all the great content that we're offering. So before I give you our take on some of the respective ETFs, just to remind you the way that CFRA is doing research on funds. So our approach is distinct in the marketplace. We want to highlight some of the reasons how it's distinct and then let you determine the usefulness of that. So we believe we're providing a very forward-looking approach, looking at the underlying holdings of the portfolio, leveraging our in-house analysts that do assessments of the valuation and risk characteristics of the portfolio. We've got a deep team of single security analysts as well as strategists that are assessing the future. And what we've done is taken that research to help us out not only on a forward-looking valuation perspective, but also to understand the risk characteristics of those holdings, also incorporating in the volatility. We lastly focus on lower cost funds. So even though we think a lot of attention or too much attention is paid to the expense ratio, that is part of our rating methodology. We also incorporate the bid-ask spread, which is a meaningful cost. You'll often find wider spreads for some of the less liquid products that are out there, and that's something to be mindful of. On the next slide here, let's just show you how our rating is developed, the individual attributes that are there. 5 of these 10 metrics are holdings-based, the 2 top ones, stars and fair value, and the 3 risk considerations factors, quality ranking, risk assessment, and S&P credit rating. They're contributing to the overall rating. The way you would view our report and view this here is if it's green, it's contributing favorably to the overall rating. You'll see for fair value or technical analysis. If it's yellow, it's neutral, like you would see for stars or for risk assessment. And if it's red, it's a down arrow, that's something that's unfavorable. So you'll see the standard deviation in particular is relatively low. We cover hundreds of ETFs that have launched in the last 3 years because we're holdings oriented. One of the ETFs we'll highlight, JVAL, or actually 2 of them, excuse me, JVAL and the Oppenheimer product, OMFL, are less than 3 years old. We're covering them. You won't find that coverage from others in the industry, even though money is going into these products and they're quite compelling. So we really think it's important for you to look inside the portfolio, and our research helps to do that. And on this next slide here, we showed this earlier, but I wanted to blow it out a bit, our track record. So even though past performance is not indicative of future results, we believe that we've been doing this for nearly 10 years. We're coming up on the 10-year anniversary, and the ETFs we like have outperformed the broader market. The ETFs we like the least, the underweight rated ETFs, have underperformed, and you can see a big differential on a 3-year basis, nearly 300 basis points between our top-rated ETFs and the bottom-rated ETFs, and that goes on throughout the period of time. So let's move here. Let's dig into some of the specific ETFs on this next slide about that we touched on. So, as promised, we're going to touch on one from iShares, one from JP Morgan, one from Oppenheimer. Stay tuned for that. So Holly talked about momentum is one of the areas that they like. We would agree. MTUM is one of our top-rated ETFs. And we would argue that this is turning into more of a traditional growth product. And there's a lot of money still in actively managed, expensive, underperforming, large cap growth mutual funds that are trying to beat the Russell 1000 Growth Index. This ETF actually offers slightly more exposure to the cyclical sectors like technology and consumer discretionary. More important to us is what's inside the portfolio, and we were pleasantly surprised to see not only attractively valued stocks that have been going up, but also ones that have high quality characteristics. So Boeing, JP Morgan Chase, and Microsoft are examples of what's inside the portfolio that score well to us from a quality perspective. And 15 basis points for something that's akin to a large cap growth approach but also offers not a static portfolio because this is a strategy that's refreshed to reflect an ongoing momentum factor twice a year. We think MTUM is a compelling product to take a look at, and our research can help to validate that. On the next slide here, let's go to the other end of the spectrum. I was intrigued to hear momentum favored from one of my panelists and value favored from the other panelists because they tend to be more of a yin and yang approach to the market. Value on the other end of the spectrum tends to have, when you look at a traditional, more market cap weighted index approach to it, tends to have exposure to energy, financials, and healthcare. JVAL, as Yasmin referred to it from JP Morgan, is sector diversified. So you have a good healthy chunk of technology and consumer discretionary and industrial stocks, as well as healthcare stocks within the portfolio, many that are appealing to us independently from CFRA. Apple, Intel, Pfizer are just some of the examples in the portfolio. And as we did earlier with using MTUM as the example, JVAL costing 12 basis points is quite compelling in relation to an average actively managed mutual fund that charges 100 basis points. This is an ETF that launched in late 2017, and as mentioned, we at CFRA are already covering it and can give you insight into not only what's inside the portfolio, but what we think of that. And then lastly, on this next slide here, let's bring Oppenheimer back in to the conversation. We spent a good amount of time, and my panelists did, about multi-factor ETFs, and Dave talked about how this product is not static, it's dynamic in its construction. So it's incorporating the 5 factors that are widely used within multi-factor ETFs, but are tilting. And so Dave touched on its focus on quality and low volatility now, but it had in the first quarter favored size, value, and momentum. As it's been currently positioned, a lot of stocks that we find to be attractive and also having low risk considerations. You'd expect that with a tilt towards quality and low volatility, but stocks like Home Depot, Johnson & Johnson, and Procter & Gamble are examples. I'd note we were intrigued to see that consumer staples was a nice, healthy part of the portfolio. I talked about how not all ETFs are sector diversified. This is not intentionally sector diversified, but it does have a nice slug in consumer staples, and that's something that's interesting. Slightly more expensive than the 2 other ETFs we've been highlighting, but if you put it in perspective versus an average large cap core mutual fund that also charges 100 basis points, and you're getting that dynamic aspect of it, we think it's certainly worthy of a look. On the next slide here, just to show you the tools that we have on our MarketScope Advisor platform. For those that don't have access to MarketScope Advisor, please reach out to us. We'd be happy to get you set up with a trial. You may have access to MarketScope Advisor and not the ETF portion of it, and thus you wouldn't see sample reports on 1,200 plus ETFs that are rated. That's what's on the left side of the screen. The Consumer Discretionary Select Sector Spider, not a smart beta ETF, but a market cap weighted ETF, has been featured for the month of September. And then on the right-hand side of the screen is an example of our thematic research. As mentioned on the registration page, you have a piece summarizing the comments from me and some of the comments that were made by the panelists. They submitted earlier that we could publish it and advocate for you taking a look at this webinar. This piece that's here was looking at fixed income ETF liquidity and driving demand that's out there. Just an example of the topics that we're covering here. And so I'd encourage you, as we move to the next slide here, to submit questions. We've been getting a good number of questions coming in, and I'll start with my panelists on that, but keep sending them in, and we'll get to as many questions as time permits. So, Holly, I touched on fixed income, an example on that screenshot that's there, and demand for fixed income ETFs. But we had a question about does the smart beta approach make sense for the fixed income portion of your portfolio?
Yeah, so it absolutely does, in our opinion, and I don't think I'm alone here when I talk about how we define what factors are, because that really sets up the question, or rather answers the question on whether or not this is applicable to asset classes outside of equities. The definition that we use for factors is that they are both broad and persistent. So on this call, we've talked a bit about persistence, or showing that they work through time, having that proven track record. But the first part of that definition, broad, says that they work across asset classes. In fixed income in particular, you have two layers of relevant factors. Macro factors define the level of asset class returns. And while economic risk is really the primary driver in equities, therefore focus on macro factors just tends to not even come into the conversation when we're talking about equities. In fixed income, it's increasingly more important. Macro factors in fixed income are variables like the level of interest rates or credit spreads, and they're really impactful to the returns on a fixed income portfolio. Style factors, or that next layer down, explain the dispersion of returns within an asset class. Variables like value orientation or how quality and issuance is are relevant both to equities and to bonds. So we offer in our lineup funds like the iShares Fixed Income Balanced Risk Fund, ticker FIBR, which balances exposure to interest rates and credit spreads in an attempt to diversify sources of risk and return, and in many ways drive higher income at a lower duration than market cap weighted benchmarks. We also, though, have products that target style factors by isolating quality bonds based on their likelihood of default, and those which are underpriced by looking at the options adjusted spread. What you can, I think, hear in what I'm articulating is that the metrics for value and quality are different in this asset class, but the underlying investment thesis and the tenets are definitely the same as equities.
So thanks, Holly. Yasmin, we had a question related to alternative ETFs. This is specifically about smart beta strategies, but I think JP Morgan uses some factor orientation as part of the alternatives that in the suite you have. Do they make, I guess, do alternatives make sense in where we are in the bull market today, given how prolonged it's been?
Yes, absolutely. This is an area we've been spending a lot of time with advisors on, and I think it's exactly what you mentioned, which is people's outlook for traditional markets, particularly when you think about what a 60-40 portfolio has done for you in the last 25 years, and square that away with where most people see the returns for a 60-40 portfolio on a go-forward basis. And what it's prompting people to ask is, what else is there out there that I can put in my portfolio relative to my traditional equity and traditional fixed income exposure? I'd add in particular, the fixed income area is one where people are looking for fixed income alternatives with the worry about rising interest rates. So I think the backdrop for alternatives is very high right now, but I would say that there have been some hurdles historically for the adoption of alternatives, particularly if you zoom in on somewhere like the ETF market. So the first area, which I think is a big hurdle that we're solving for, is cost, which is that historically alternatives have been extremely expensive. So when you think about a private structure, for example, many of them have very hefty management fees as well as incentive fees. So when you actually look at the return stream net of transaction costs, the story isn't so attractive. So I think one of the things we think about in terms of solving problems is, how do we deliver that same attractive diversifying return source at a lower cost? The second area that I think there's a high degree of innovation needed is just access altogether for the ETF market. So if you look at the category for core alternatives in ETFs, there's really less than 10. That's about 17 times lower than the mutual fund category. So said differently, if you predominantly use ETFs, while historically, in let's say the last 10 years, given what equity markets have done, you haven't really needed an alternative. Now, as you're thinking about it, you didn't really have a lot of choice. So that is the backdrop of what we were trying to solve for, is we think the macro environment's very attractive right now, but you didn't have a lot of choice as an ETF investor, and of course, many of what you did have was very expensive. So that was why we launched our suite of 4 alternative ETFs. Our core in that strategy is JPHF. And essentially what we're seeing clients use those for is a core diversifier in their portfolio, either funding it from their equity bucket, which is really about a risk reduction story, or funding it from their fixed income bucket, which is about their prospects for interest rates and looking for another diversifying return source in that macro context. So I do believe right now is a really attractive time, and I think, really what you're seeing is a lot of innovative strategies come to the ETF market to solve for that.
So thanks, Yasmin. Dave, I'll put this one towards you. We spend a lot of time, and good time, I think, talking about the U.S. orientation of factors in smart beta, but many investors should have a global portfolio, and oftentimes they're using a market cap weighted approach tied to the EFA or other strategy or other indices, do smart beta and factor strategies make sense outside of the United States?
Yeah, as Holly noted, certainly market cap weighting strategies, ETFs, index-based funds can still be relevant to help build the core of investors' portfolios. But what's interesting about factors in general, one of the ways to judge if a factor actually exists, not that it just kind of works in a back test or some idea that doesn't actually have any economic principles behind it, is to test, and Holly used the word broad, another word is pervasiveness, right? So what we mean by pervasiveness is, does it actually work within a particular market across markets? Meaning, does it work in large cap, mid cap, small cap? Does it work across sectors? Does it work in the UK? Does it work in the US? Does it work in Japan? Does it work in Australia? If a factor, generally can't live up to those standards, then it may not actually exist. Now, there are other principles that need to come to mind. Does it persist, right? Does that factor actually have long-term efficacy? Does it not just work in one particular market environment? Does it actually work after transaction costs? That's pretty relevant, meaning is it actually liquid? Is it implementable? And then really, frankly, is it intuitive? Does it actually make sense? And what we find is actually all of those principles do exist outside of the U.S. for the most part. So what we tend to see, while there's been more focus on U.S. portfolios and ensuring that they're as robust as possible as our economic and interest rate cycle evolve, I think we're going to actually begin to see really a large interest in factor-based products for exposures outside of the U.S., whether that's international, developed, or even emerging markets.
So thanks, Dave, and thanks everybody for that. I'm going to bring everybody into this question because we hear a lot about fees and how the money is going after the lowest cost products. As mentioned earlier, we use at CFRA an expense ratio as part of our metric, but also holdings-based analysis. So I know where I and we at CFRA stand on this, but Holly, I guess I'll ask you first, and then we'll bring everybody into the conversation. What beyond fees, what is, or beyond expense ratio is important when looking at smart beta strategies in particular?
Thanks, Todd. I think, there's a lot to consider when you're thinking about any investment. And certainly when you think about cost, I think it's important to anchor not on the absolute value of the fees necessarily, and certainly not in isolation, but really what are you getting for those fees? And so when we think about what investors should be paying for, they should be paying for the exposure that they've asked for. What I mean by that is, do you have a high enough concentration if you believe that these factors, like value or quality tilts in a portfolio, should drive better returns over time? Are you actually getting a meaningful tilt to those factors in the investment that you have chosen? And if you aren't, then certainly fees matter. You should not pay more than you should for a product that's going to perform a lot like market cap weighted beta. But to the extent that you have a higher concentration, that should warrant a higher fee. Higher skill in building the product should warrant a higher fee. And so I think fees definitely need to be a part of the due diligence process. But I think in isolation, the absolute level of fees should not be the only thing considered. Any purchase that you make, there are multiple variables that should be weighed. In addition to that, I think most often, because these are ETFs and ETFs have historically been market cap weighted, most of the AUM is there. When we think about fees, many look at these and see them as priced at a premium to market cap weighted beta ETFs. But like all of us have talked about on this call today, in most cases, the advisors that I'm working with are actually looking to replace active management. They're looking to find more consistent drivers of return. They're looking to reduce overall fees in the portfolio. And when you look at the average price of smart beta or factor ETFs, they are priced at a fairly significant discount on average to active management. And so again, you need to consider more than the absolute level. You need to understand the exposure you're getting, but then also recognize what's the right benchmark for relativity when looking at what is quote unquote expensive versus inexpensive.
Okay, Dave, anything to add to that?
Yeah, I think those are some great points. I think we've become very expense ratio focused because it's readily available to us. And in a world where returns are compressed, expenses really matter. Think about fixed income. Any additional fees had been likely eating away at that potential for yield when interest rates were really effectively pinned at zero. Now, that is, of course, evolving. But what's interesting here is with the focus on fees, maybe it's very relevant just for if we're only comparing extremely like-to-like products. Let's say they, market cap ETFs, for example, in the S&P 500. I can see why investors are overly focused on fees. Now, certainly you need to look at bid-ask spreads, tracking error, et cetera. So you have to think about the total cost of ownership and what your aggregate client experience will be like. But outside of just the exact same exposure, it's really important to know what you own. And I think that's what Holly's getting at in her response is we can, with additional data, and one of the great things about ETFs, of course, is that it's transparent to you, and most fund providers do a great job on their websites showing you a lot of information and providing additional detail in the form of the index methodology to understand, is the fund actually delivering on what it's saying it's supposed to do? So I can look at the expense ratio, I can look at trading volume, look at bid-ask spread and understand it, and then really understand, well, what am I actually going to get? And that's why I think holdings-based approaches can actually be particularly beneficial for investors. Not that past returns don't matter, they're certainly relevant, but really understanding what the current portfolio looks like today, what it may look like in the future, may be more important for factor-based products, even more so than market cap.
So before I bring Yasmin back into this, I'll say we at CFRA, as we showed on the screen here, are holdings-based as opposed to looking backwards. So we agree. Yasmin, anything to add to that? And then I've got one additional question to bring to the audience.
Yeah, maybe just a few points to add there. One of the biggest, I think, hurdles that exists for advisors when they're thinking about these products is the unintended biases that can come along with factor exposure. And what I mean by that are sector concentrations, stock concentrations, and unintended factor biases. And so one of the things I think we would urge investors to do is look under the hood of what the underlying methodologies are for funds that sound seemingly very, very similar, right? So you say you have a value fund, you think it should operate very similar to another value fund. But if you actually go through the different dimensions, you look at the way that sectors are weighted, what you may find is some constrain their sectors, some do not. The implication of that, for example, is that you may end up having vastly different sector allocations. Ones that don't constrain their sectors, for example, you can find that they go up to 40, 50% and move around quite a lot. You have to understand whether that's the concentration you want or don't want in your portfolio. That same thing exists at the stock level. If you think about some of these factor portfolios, they're narrowing the universe down by a particular factor. And so you can end up finding that you have significant concentration in individual stocks and a small set of stocks. And I think a question to ask yourself is that rewarded, or is it just idiosyncratic risk that's being created in the portfolio? All of that said, I do think that one of the things that just sort of makes it obvious is the dispersion of return that you see when you look at different funds that appear seemingly the same based on their headline name. I would definitely go 3 steps deeper on these types of products. And I'd also try to understand who's the manager behind your product. While these are systematic in nature, they're absolutely research-based. And I think that's something that advisors really do need to focus on, is that they come from a place of research despite the fact that they are implemented on a systematic basis.
So thanks, Yasmin. We're going to do one final question that came in because we've heard about it as well, and I'd love to get everybody's take on this. And Dave, I'll start with you. Is there too much money chasing the same factors? Everybody here talked about different ones, but you all have using the same factors within the approach. Is there too much going after value or too much going after quality, for example?
Look, I think first and foremost, it's a reasonable question to think about, right? As these products have become more popular, they become part of investor lexicon. So definitely the right question to ask. With that being said, I think we're still talking about areas that are particularly small in the aggregate, both off of assets under management and on the trading volume impact that it can have, for a few reasons. One is what Yasmin was just mentioning. While there are a multitude of different valuation factors, and many of them exhibit high correlations, in fact they should if they are looking for a value stock for example, the way the actual product, the way the actual index is constructed can vary markedly. So while people are, not everyone is looking just at book to price, for example, or earnings to price. So that's important and relevant, is that the actual definitions are particularly distinct, and that actually helps bring diversification of what actually names may actually be being traded on any particular day. Although, in our opinion, the aggregate assets are still particularly small. And then outside of that, just simply is that the real reason, again, in my opinion, that these factors can exist. Now, there are other explanations which would be considered risk-based explanations, which are meaning that there's something inherent about the individual companies, and that's why this actual risk-adjusted premium exists, is actually because of behavioral biases. And unless we think investor behavior, for example, in the future will change, then we actually continue to expect factors to perform well. The logical question, people will say, well, hey, Dave, value hasn't worked for 10 years. Maybe it's never going to work again. Well, go back to the long-term data sets, whether it's FAMA or French or others, and you'll see periods where value actually can perform very poorly for a long period of time. So it's important not just to let our kind of near-term information judge, again, the persistence of a particular factor. Although as these products grow, just like other areas of the market, probably a conversation for another day, like fixed income ETFs, reasonable things to be thinking about and monitoring.
Great. Yasmin, Dave referenced your comments, but anything you want to add back to that? Is there too much money going after the same factors?
Yeah, I think maybe I'd just add two things. The first is, I think there's a lot of hype around quote-unquote smart beta, but I think it's worth distinguishing that from the reality of factor-based investing, which has been around for quite some time. So this is not a new development in the market. Active managers have been using them in their portfolios for quite some time. Hedge funds have been using them in their portfolios for quite some time. And so what may feel like a fad of sorts and create this feeling of a lot of money moving into it, I actually almost think in some sense it's reclassifying investing that's been around for a long amount of time. But I do agree with Dave, it is the right question to ask, which is if we let our mind go even farther, where we were in a world where there was a significant amount of factor-based investing relative to, let's say, traditional active or index, what would that mean for the very basis of some of these factors? And I also would go back to the economic rationale for why they exist altogether. Or maybe another simpler way to think about it is when we think about money moving into the equity markets, just the equity risk premia, nobody really questions the basis for that exposure. What they say is it looks relatively rich or cheap relative to historicals. And what you see is a cycle, right? When that becomes expensive, people deallocate and money moves out and it becomes cheap and attractive again. And so similarly, we would see other factors in that same vein, which is if we truly believe there's an economic basis for it, then just like the market, they can go up and down in richness and cheapness, but the fundamental reason for why they exist does not go away. With that said, I do think that there are some things to monitor, which is how long and short factor cycles can be. Now, in a world where factor products have become increasingly accessible, right now they're in the ETF wrapper, which is essentially the most accessible format they can be in. One thing to monitor is will we see a shortening of cycles, which we haven't seen, of course. In fact, in some sense, we've seen a lengthening of cycles. But I do think there are some implications that are worth putting on the radar to monitor, not the basis itself, but maybe the way they operate in the market.
Thanks for that. Holly, anything to add?
Yeah, the only thing I would add is I would echo everything that Yasmin and David have said here and simply add that, as I mentioned a few times throughout the webcast, a lot of the clients that we're working with aren't new to quality and buying quality investments or buying value investments, as an example. They're selling out of an active manager who was already telling them they were delivering on those exposures to reduce costs in the portfolio and improve tax efficiency. So the dollars that we're seeing come into quote unquote smart beta or factor ETFs, I don't believe are net new, and based on all the calculations and research our firm has done, aren't actually net new to these strategies. And so I think we have a long way to go before we need to worry about too great of a concentration in assets in any one of these factors. Because if we think about, if we size the market, we have $4 to $5 trillion in fundamentally managed style box market cap weighted U.S. equities. If we see those assets move into factor funds, that's still not net new assets into these types of vehicles. So I think that's really the thing to watch here is as we see the market shift over time, we have a long way to go before we're worried about arbitraging away the value out of these tilts in a portfolio.
So this is Todd just chiming in. We would certainly agree. There's a lot more money in expensive, underperforming, actively managed mutual funds, and if they might be able to keep up if they brought their fees down and did more of a systematic approach, and we're certainly seeing investors head towards that. As we move to the next slide here, and thank you everybody for staying with us past the hour. We're pleased that you did. Before I thank my panelists and thank you all for doing so, I want to tease up the next CFRA webinar, Seasons Change, Sector Change. We're excited about this. I'm going to be a part of this, but I'm going to be riding in the back seat while Sam Stovall and Lindsay Bell, our investment strategists, talk about our CFRA's outlook heading into the fourth quarter, tied to earnings season, tied to our favorite sectors I touched about earlier, but some of the sector changes that are made. That event is going to be moderated by Scott Kessler, one of our directors of equity research, to get the latest view that's there. Within the next day, you will receive a link to the replay and slides from today's session. Some of that information you can find on the registration page, as well as the other commentary. And I want to thank Holly, Yasmin, Dave, their respective teams for helping us put together this great event. Thank you all for listening to it. If you wanted to learn more about the ETFs they talked about, obviously their websites would be a great resource there. If you wanted an independent, objective view, you can find that coming from CFRA on MarketScope Advisor, and we'd be happy to get you more access to it. And should you have any questions, don't hesitate to reach out to us at cservices@cfraresearch.com. Thank you all for participating in this, and have a great rest of your day.